Dollar cost averaging just $100 per month into crypto can potentially build significant wealth over time. And it's a strategy that requires no market timing, no technical analysis, and no emotional decision making. While most people try to time markets and end up buying high and selling low, DCA investors systematically build positions regardless of market conditions. In this comprehensive guide, I'll show you exactly how to implement a professional DCA strategy, which cryptocurrencies to include, and how to optimize your approach for maximum long-term wealth building. Before diving into specific strategies, let's understand what dollar cost averaging actually is and why it's so effective for crypto investing. What is dollar cost averaging, DCA? DCA is an investment strategy where you invest a fixed amount of money at regular intervals regardless of market price. Fixed amount, same dollar amount invested each period, weekly, monthly. Regular schedule, consistent timing removes emotional decision making. Price, agnostic. Buy at high prices, low prices, and everything in between. Long-term focus, strategy designed for wealth building over years, not months. Why DCA works particularly well for crypto. Cryptocurrency markets have unique characteristics that make DCA especially effective. High volatility. Large price swings provide opportunities to buy at various levels. Emotional markets. Extreme fear and greed create optimal DCA entry points. Long-term growth. Trend. Despite volatility, quality cryptos have appreciated significantly. 24/7 markets. Constant price movement provides regular DCA opportunities. The psychology of DCA works because it removes human emotion from investing, eliminates timing pressure, no need to predict market tops or bottoms, reduces FOMO. Systematic approach prevents impulsive buying during hype, builds discipline. Regular investing creates positive financial habits, manages regret. Spreading purchases reduces regret from any single entry point. Mathematical advantage. DCA provides statistical advantages in volatile markets. Volatility, harvesting. More shares purchased when prices are low. Average cost reduction tends to result in lower average cost basis. Compound growth, reinvestment of gains compounds over time. Risk reduction, spreads timing, risk across multiple purchase points. Common DCA misconceptions, it's always best. DCA isn't optimal in every scenario, but it's consistently good. Set and forget. Successful DCA requires periodic review and optimization. Works for everything. Asset selection still matters significantly for results, guarantees profits. DCA reduces risk but doesn't eliminate market risk entirely. The success of your DCA strategy depends heavily on choosing the right cryptocurrencies and allocation percentages. Tier 1, core holdings, 60-80% of DCA. These should form the foundation of your DCA strategy. Bitcoin, BTC, 40-60% allocation. Rationale, most established cryptocurrency with longest track record. Characteristics, digital gold narrative, institutional adoption, store of value. Volatility, lower volatility than most altcoins, but still significant long-term thesis. Continued adoption as digital reserve asset. Ethereum, ETH. 20-30% allocation. Rationale. Leading smart contract platform with diverse ecosystem characteristics. DeFi infrastructure, NFT platform, enterprise adoption growth drivers. Network effects, developer activity, institutional use, risk factors. Competition from other layer 1 platforms. Regulatory uncertainty. Tier 2. Growth holdings, 15-25% of DCA, higher risk, reward opportunities for portfolio growth. Solana, SOL, 5-10% allocation. Rationale, high performance blockchain with growing ecosystem characteristics, fast transactions, low fees, active development, growth potential. DeFi, gaming and application development. Risk factors, network stability concerns, competitive landscape. Cardano, ADA or Polygon, Matic. 3-7% allocation. Rationale. Established platforms with different approaches to scaling characteristics. Academic approach, ADA versus Ethereum scaling, Matic. Portfolio role. Diversification from Ethereum-centric positions. Risk considerations, execution risk, competitive positioning. Tier 3, speculative holdings, 5-15% of DCA, small allocations to higher risk opportunities. Emerging layer 1s or DeFi tokens, 2-5% each. Examples, Avalanche, Cosmos, Chainlink, Uniswap. Rationale, exposure to specific crypto sectors or technologies. Risk profile, higher volatility, higher potential returns. Portfolio impact, small positions that could drive outsized returns. Asset allocation examples, conservative DCA portfolio. Bitcoin, 70% Ethereum, 25% cash, reserve, 5% balanced. DCA portfolio: Bitcoin 50%, Ethereum 30%, top altcoins 15%, speculative positions 5%, growth-oriented DCA portfolio. Bitcoin 35%, Ethereum 25%, established altcoins 25%, emerging opportunities 15%, rebalancing considerations. Quarterly reviews: assess allocation percentages and market conditions. Threshold: rebalancing. Rebalance when allocations drift beyond target ranges. Market cycle adjustments: modify allocations based on market cycle phases. New opportunity integration: add promising new assets through small test allocations when and how often you. DCA can significantly impact your results over time. DCA frequency analysis: daily DCA pros, maximum volatility smoothing, minimal timing risk. Cons: higher transaction fees, more complex to manage, best for large portfolios where fees are proportionally small, platforms, automated services that support daily purchases. Weekly DCA pros: good volatility smoothing with manageable complexity. Cons: moderate transaction costs, still requires regular attention, best for active investors comfortable with weekly management timing. Pick consistent day of week regardless of market conditions. Monthly DCA pros: lower fees, easier management, builds consistent habits. Cons: more exposed to monthly timing, less volatility smoothing. Best for most retail investors, especially beginners. Timing: choose consistent date each month, 1st, 15th, etc. Biweekly DCA every 2 weeks. Pros: balances frequency with simplicity, aligns with pay periods. Cons: moderate complexity, timing considerations. Best for investors paid biweekly who want to align DCA with income strategy. Invest portion of each paycheck automatically. Timing considerations. Market timing. Myths: common misconceptions about optimal DCA timing. Buy the dip mentality defeats the purpose of systematic DCA. Wait for crashes, missing consistent accumulation opportunities. Time of day matters. Daily timing has minimal long-term impact. Day of week optimization. Weekly patterns are inconsistent and unpredictable. Smart timing strategies: legitimate timing optimizations that don't break DCA principles. Paycheck alignment: DCA when you receive income for cash flow management. Fee optimization: choose times when exchange fees are lower. Network congestion: avoid peak network usage for lower transaction costs. Tax year planning: consider tax implications of purchase timing. Enhanced DCA techniques: value-based DCA, adjust DCA amounts based on market conditions. Fear and greed: index increase purchases during extreme fear, moving average positions. Buy more when price is below long-term averages. Volatility adjustment: increase DCA during high volatility periods. Implementation: use 0.5x to 2x multipliers on base DCA amount. Graduated DCA: start small and increase over time. Income growth: increase DCA amount as income increases. Confidence building: start with comfortable amount, increase as you learn. Market understanding: expand strategy as market knowledge grows. Risk capacity: adjust based on changing risk tolerance and capacity. Choosing the right platforms and automation tools is crucial for successful long-term DCA execution. Exchange-based DCA platforms: Coinbase. Pro: advanced features. Automated recurring buys, professional interface fees, 0.5% for automated buys, lower for manual trades. Assets: wide selection including major cryptocurrencies. Pros: user-friendly, established platform, good for beginners. Cons: higher fees than some competitors, limited advanced features. Kraken features: DCA automation, advanced order types. Fees: competitive fee structure, especially for higher volumes. Assets: extensive cryptocurrency selection. Pros: strong security record, professional features. Cons: more complex interface, less beginner friendly. Binance.us features. Flexible DCA options, extensive tools. Fees: very competitive, especially with BNB fee reduction. Assets: largest selection of cryptocurrencies. Pros: low fees, comprehensive platform, global reach. Cons: regulatory concerns in some jurisdictions, complex interface, specialized DCA services. Swan Bitcoin: focus, Bitcoin only, DCA service. Features: automatic withdrawals, educational resources. Target: Bitcoin maximalists and long-term holders. Pros: Bitcoin focused, automatic self-custody. Cons: Bitcoin only, higher fees than general exchanges. River Financial focus, Bitcoin DCA with professional tools. Features: low fees, automatic DCA, institutional grade security. Target: serious Bitcoin investors. Pros: professional service, competitive fees. Cons: Bitcoin only, limited to certain jurisdictions. Strike focus, Bitcoin DCA with Lightning Network integration features. No fees for DCA Lightning integration. Target: Bitcoin users wanting zero fee accumulation. Pros, zero fees, Lightning Network access. Cons, Bitcoin only, newer platform automation. Best practices, security considerations, protecting your automated DCA setup, exchange security, use platforms with strong security records, API security, limit API permissions to necessary functions only. Two-factor authentication, enable 2FA on all accounts. Regular monitoring, check automation systems regularly for issues. Backup plans, preparing for automation failures. Manual backup, be prepared to execute DCA manually if automation fails. Multiple platforms, consider diversifying across platforms. Notification systems, set up alerts for failed transactions. Regular reviews, monthly checks of automation performance. Cost optimization, minimizing fees and maximizing efficiency. Fee structures. Understand all fees, including spread, transaction, and withdrawal. Volume discounts. Some platforms offer better rates for higher volumes. Native token benefits. Platforms often offer fee discounts for using their tokens. Withdrawal timing. Batch withdrawals to reduce per transaction costs. Successful DCA requires managing both market risks and psychological challenges. Risk management framework, position sizing, and capital allocation. Never invest more than you can afford to lose. Emergency fund. First, maintain 3 to 6 months expenses before DCA investing income. Percentage, generally 5 to 15% of income for crypto DCA risk capacity assessment. Consider age, income stability, and financial goals. Gradual scaling. Start small and increase as comfort and knowledge grow. Diversification strategies spread risk across multiple dimensions. Asset diversification, multiple cryptocurrencies with different use cases. Time diversification, regular purchases, spread timing risk. Platform diversification, use multiple exchanges to reduce counterparty risk. Geographic diversification, consider regulatory risk across jurisdictions. Market risk management understanding and preparing for crypto market realities. Volatility expectation, prepare for 50-80% drawdowns in portfolio value. Correlation, understand that most cryptos are highly correlated. Regulatory risk, consider potential regulatory changes affecting crypto technology. Understand risks of early stage technology adoption, psychological challenges and solutions, common psychological pitfalls. Mental challenges that derail DCA strategies. Impatience, expecting quick results from long-term strategy. FOMO, wanting to increase purchases during bull markets. Fear, stopping DCA during bear markets when it's most effective. Overconfidence, increasing risk after early success. Building mental resilience, strategies for psychological success. Education, understanding market cycles reduces emotional reactions. Historical perspective, study past cycles to understand normal volatility. Support systems, connect with like-minded long-term investors. Regular reviews, scheduled portfolio reviews prevent impulsive decisions. Dealing with bear markets, DCA really proves its value during downturns. Continue the plan. Bear markets are when DCA accumulates the most increase if possible. Consider increasing DCA during extreme downturns. Avoid panic. Remember that bear markets are temporary but normal. Focus on accumulation. Measure success in assets accumulated, not dollar value. Managing success, psychological challenges of profitable DCA. Profit taking. Develop systematic approaches to taking some profits. Risk creep. Avoid increasing risk significantly after success. Lifestyle inflation. Don't count unrealized gains as spending money. Long-term focus. Remember that DCA is a multi-year strategy. Once you master basic DCA, these advanced techniques can enhance your results. Enhanced DCA methodologies. Smart DCA with market indicators, using objective indicators to optimize DCA timing. RSI-based adjustments. Increase DCA when assets are oversold. Moving average signals. Buy more when price is below long-term averages. Fear and greed. Index. Increase purchases during extreme fear periods. On-chain metrics. Use blockchain data to identify accumulation opportunities. Graduated risk. DCA adjusting strategy based on market cycles. Bear market. Increase allocation to quality assets during downturns. Bull market. Maintain discipline. Consider reducing speculative allocations. Sideways markets. Standard DCA approach with possible rebalancing. Transition periods. Careful monitoring and gradual adjustments. Tax-optimized DCA structuring, DCA for tax efficiency. Tax advantage accounts. Use IRAs or other retirement accounts where possible. Long-term holding, structure to maximize long-term capital gains treatment, loss. Harvesting, strategically realize losses to offset gains. Record keeping, maintain detailed records for tax reporting. Advanced portfolio construction, barbell, DCA strategy. Combine conservative and aggressive positions. Conservative core, 70-80%. Bitcoin and Ethereum for stability. Aggressive satellites, 20-30%. Higher risk, higher reward positions. Rebalancing, periodically rebalance between conservative and aggressive sector rotation. DCA adjust allocations based on crypto sector performance. DeFi focus, increase. DeFi allocations during decentralized finance growth infrastructure plays, emphasize layer ones and scaling solutions. Application layer, increase exposure to gaming, NFTs, and consumer apps. Timing, gradual shifts rather than dramatic reallocations. Geographic and regulatory arbitrage, consider regulatory environments in DCA planning. Jurisdiction shopping, consider tax-friendly locations for crypto holding. Regulatory timing, adjust strategy based on regulatory developments. Compliance planning, ensure DCA strategy complies with local regulations. International diversification, consider global crypto investment opportunities. Successful DCA requires ongoing monitoring and periodic optimization without abandoning the core systematic approach. Performance tracking framework, key metrics to monitor. Track the right indicators for DCA success. Dollar cost average, your average purchase price across all buys. Total return, overall portfolio performance including unrealized gains, risk-adjusted returns, performance relative to volatility experienced asset accumulation, total units accumulated of each cryptocurrency consistency score. How well you've stuck to your DCA schedule, tracking tools and spreadsheet systems for monitoring DCA performance, manual tracking, spreadsheets with purchase dates, amounts, and prices, portfolio apps, CoinTracker, Blockfolio, or similar for automated tracking. Exchange reports, built-in reporting tools from DCA platforms, tax software, tools that help with both tracking and tax reporting. Regular review schedule, systematic approach to DCA evaluation. Monthly reviews, check automation, verify purchases. Review performance, quarterly assessments. Evaluate allocation percentages and rebalancing needs. Annual planning, comprehensive strategy review and adjustments for next year. Market cycle reviews, major adjustments only during clear cycle transitions. When and how to adjust, legitimate reasons for strategy changes. Valid reasons to modify your DCA approach. Income changes, significant changes in income affecting DCA capacity. Life circumstances, major life events affecting risk tolerance or time horizon, market structure. Changes, fundamental changes in crypto market structure. Better opportunities, clear improvements in available DCA platforms or assets. Red flag adjustments to avoid changes that usually indicate emotional decision making. Recent performance, adjusting based on last few months' performance, market timing. Trying to time market tops and bottoms. FOMO additions, adding assets because of recent price performance, panic reductions. Reducing DCA during market downturns. Optimization without abandonment. Improving DCA while maintaining systematic approach. Fee reduction, moving to lower cost platforms or methods. Automation improvement, better automation tools or processes. Tax optimization, structuring for better tax treatment. Asset quality, upgrading asset selection based on fundamental analysis. Exit strategy, planning for eventual DCA conclusion, goal-based exits, clear targets for when to begin taking profits. Time-based exits, planned reduction in DCA as you approach retirement. Systematic profit taking, gradual reduction rather than all or nothing exits. Legacy planning, estate planning considerations for accumulated crypto dollar cost averaging is one of the most powerful wealth building strategies available, and it's perfectly suited for the volatile but growing cryptocurrency market. The key is starting with a systematic approach and maintaining discipline over time. Here's how to begin your DCA journey. First, subscribe to this channel for ongoing DCA education, market analysis, and strategy updates as the crypto landscape continues evolving. Second, start small with an amount you're comfortable with. Even $25 or $50 per month can build significant wealth over time through the power of compound growth and systematic investing. Finally, share in the comments what your DCA allocation would be and why. Whether you prefer Bitcoin heavy, balanced across multiple assets, or include some speculative positions, let me know your approach. Remember, the best DCA strategy is the one you can stick with consistently over years, not months. Focus on building sustainable habits, managing risk appropriately, and letting time and compound growth work in your favor.